Hey guys, in one of my most recent videos, I got a comment with someone saying they didn't understand the difference between an income ETF and a dividend ETF, since the idea behind both of them is to receive regular income. So what's the difference between an income and a dividend ETF? And this is coming off the back of one of my spreadsheets where I try to break down investing strategies or investing styles in a simple quiz, answer these questions, and it'll spit out what type of investor it thinks you are. This is a free quiz. Just click File, Make a Copy. The link will be in the description. Don't need to sign up or username, password, or Patreon or anything. Just click the link in the description. It'll send you right over to this Google Sheets. So in this video, we're going to take a closer look at what an income ETF is and what a dividend ETF is, and then try to answer which one is best for you in your current situation. So real quick, to unpack an income ETF, let's go over to two of the more popular income ETFs at the moment. So SVOL is the first income ETF that we're going to be looking at, and the second is going to be SPYI. Now on both of these funds strategy section of their website, they have something called an option strategy, or they let you know that they utilize some type of call option strategy. And over on SVOL's page, again, it says some type of call option strategy. So what is an options strategy, or what is a call or a put for that matter? Taking a look over on my Robinhood, I do a little bit of options myself. Now I'm not very good at it, but I have dabbled in it this year. And this is my year to date, only using options. You can see there's periods where I haven't had any options at play, but year to date, I am up around 110%. Now 110% return in 1 year is actually pretty incredible. And that's the power of options. If you buy the correct option, your returns can be incredible. And at one point, I was up around 262% after 6 months of the year. So you can see the power of options and the incredible amount of returns that you can receive from options. And you can see that some of these funds, if they were to play the options game right, that they would have 50 to 100 to even 200% returns if done correctly in a correct strategy. So real quick under the hood of what an option looks like, and I think Robinhood is a pretty good, has some pretty good explanations for it. Let's just take one of my current option plays, Rivian, ticker symbol RIVN. So I bought this option on June 27th with an expiration date here on August 16th. And currently this option is only up $9. But at one point, I was up around 110%, where currently I'm only up 0.72%, where I am just about to break even. So this can be pretty risky. You can see at one point I was down a almost 100%, where I almost lost all of my money, but Rivian did skyrocket up here, and that was kind of the expectation with some of the news articles that I was reading. Back on the main screen, to make it pretty simple here, going to Rivian's main page here on Robinhood, you click the Trade Rivian Options button, and you might have to sign up or sign a waiver because options can be pretty risky. So there's only 4 style of options. It's either buy a call, buy a put, or you're selling a call and selling a put. So you're basically taking a guess at what you think the price is going to be for a certain stock and what you think the price is going to be at a date. At August 2nd, at August 9th, 16th, 23rd, 30th. Now I know there could be some better explanations out there, but that's basically what options are in a nutshell. You're basically trying to take a stab at what you think the price is going to be, if it's going to be higher or lower than today, and at what date you believe that price is going to be higher or lower. So that is what these income ETFs are doing. They're buying and selling calls. In SPYI, their strategy is to buy or sell an option. So that's what an income ETF is. So just a greater understanding of a dividend ETF, I want to highlight 2 of the more popular dividend ETFs. The first one being SCHD and the second one being DGRW. Now it took a little bit of digging to try to find the selection criteria for these 2 separate ETFs. What SCHD is actually doing is, if you take a look at their holdings, they're not doing options, they're not buying and selling calls or puts, guessing at a price. They're buying a company and holding it long term for you. But they're making their stock selection criteria based on a specific methodology. And it took me a little while to find SCHD's methodology. Taking a look at their website, it says they try to track the total return of the Dow Jones US Dividend 100 Index over on the Dow Jones or S&P Global's website. Coming down to this page here on their index, checking the methodology, and on this PDF on page 21, they have an explanation of the criteria for this index, the Dow Jones US Dividend 100 Index, which SCHD tries to track the total return of. And on page 21, we find that the Dow Jones US Dividend 100 Index has a screen for the stocks that it picks in its portfolio. And the first one would be a minimum 10 consecutive years of dividend payments. The second would be having a float adjusted market capitalization, FMC, of $500 million, basically saying that that company has to have a valuation of at least $500 million. The third would be having a 3-month average daily value of trading at around $2 million. So in a nutshell, these two things mean that it needs to be a stock that has a relatively high market cap, at least at 500 million, and then has a fairly large trading volume for a 3-month period. So what does that give you? That gives you, at least in SCHD's purpose, they try to track that index. That gives you the top 10 holdings being these different companies, where the top company is going to be Lockheed Martin. Coming over to DGRW's webpage, if you click this link right here, to try to learn more about the index that this ETF is tracking. Now, they're not as transparent as the Dow Jones 100 index, but they do say something I'd like to highlight here is that they try to combine a rank of growth and quality factors, with the growth factor ranking based on long-term earnings growth expectations, and the quality factor ranking is based on a 3-year historical average for return on equity and return on assets. So what they're doing is taking a list of companies or stocks and then ranking them based on a growth factor and a quality factor. So what does that give us for DGRW? With that growth and quality rating, that gives us Microsoft, Apple, and Broadcom as the top 3 stocks, with around 30% in the technology sector for DGRW. So that's what we're looking at for dividend ETFs. And to summarize, the difference between income ETFs and dividend ETFs, income ETFs are based solely on trying to produce a very consistent amount of income in SVOL and SPY. You can see SVOL, there isn't much price appreciation after the first 12 months that this fund was out. There was very little price fluctuation, only fluctuating around $1 or so over the past 2 to 3 years. And they've paid out a pretty consistent 16% yield for 3 years. Same thing with SPY. There does look like there is some price fluctuation, but taking a look at the actual fluctuation, it doesn't really move that much. It's only dipped down to around 46, and the share price has only gone up to about 50. So it's stayed within plus or minus 2 from its starting price, with a very consistent yield of close to 12%. So in summary, income ETFs are there not for any price appreciation. They are simply there for somebody that wants a consistent amount of income and a high amount of income. Imagine if you had $1 million in retirement and you owned SVOL, 16% would be a $160,000 paycheck per year. Think about if you were shooting for a number for retirement, SVOL gives you the power to hit a decent salary of $60,000 to $70,000 at a far smaller portfolio size. And then dividend ETFs do pay you a dividend or a yield, but not as much as an income ETF. And the dividend ETFs are built around a stock selection criteria, but you should expect a price appreciation with a dividend ETF, you should expect your portfolio to grow as you own these ETFs, but don't expect a fairly large dividend yield or to try to live off SCHD with only $500,000 in your account. Same thing with DGRW. Expect some price appreciation. However, the dividend yield is very low, where you would need $3 to $4 million to have the same amount of income as an income ETF. So that begs the question, which one is going to be best for you? I would say first, try to consider the risk factors. Income ETFs are a fairly new concept, with money managers trying to play the options market and produce outsized dividend yields compared to the traditional dividend ETFs. Dividend ETFs definitely have been a tried and true stock market investing strategy. You may need 3 to 4 times the amount in your portfolio to pay you the same paycheck in a dividend yield, but there is a little bit more security in knowing that you're simply owning the stock and you're not betting on someone being able to predict the ups and downs of the market. So to answer the question, which one is the best for you? I would say first, try to understand your risk tolerance. If you're someone that can accept a little bit more risk with a higher paycheck, then an income ETF might be for you. If you're someone with a little bit lower risk, then a dividend ETF might be for you. Head down into the comments, let me know what you thought of this video and of this analysis. Let me know what you want to see next. And with that, thanks for watching.